All right, guys, so today we got something very special for you guys. A lot of you guys want to get out into the marketplace and invest in real estate, but have no clue where to start. I'm in the same boat too as well. There's a lot of people out there that have money, right? And some people don't have money. So today we're going to be talking about creative financing with my man, Jay, right? And last time you were here, we talked about what? Creative financing, right?
Airbnbs, short-term rentals.
Okay. No, I'm talking about after that.
Our second meeting, yes.
Yeah.
We talked about
and
creative financing.
It was very interesting because you own 28 properties.
Yes.
Okay. And I've got money in the bank. And I got a lot of money in the bank. I don't want to toot my horn, but, I became a real estate agent because I wanted to get into investing. So I bought a couple investment properties. But one of the challenges that I noticed that a lot of investors have is they tend to run out of money. But after talking to this dude right here, he was telling me that he has 28 rental properties. And out of the 28 rental properties, did you use any of your money?
In the beginning, I borrowed some money, or I partnered. I partner with a lot of people, other investors, and friends and family on these rentals, which is great. And then we'll go into the creative financing where it's not as expensive to invest. Yeah. But yes, I have.
So a lot of investors will run out of money, and at this point, a lot of investors will need to go out and find some money and try to find these deals. And I always hear this, creative financing, but there's so much different types of creative financing. So let's start off with, what is creative financing?
Creative financing is just you're buying a piece of real estate and just structuring the way it's purchased differently than just going out and buying a house with a traditional loan.
Okay.
So we're just we're just using a different direction of how to purchase the house.
Okay. So there are all different types of creative financing, right? We talked about what? Subject to
investing. And
owner will carry?
Owner will carry, seller finance.
Is there like an option to purchase too, I think, as well?
Lease option is another one too.
Okay. So today what we're going to do is really focus on owner will carry.
Yep.
Right? So what is owner will carry?
Owner will carry is just you're buying a piece of property. Let's say you own a house, house A. And you're saying, Jason, instead of going to the bank and getting a mortgage to purchase this property, I'm going to become the bank and I'm going to finance it to you.
Okay.
Okay, so you'll see a lot of these owner will carries with properties that are completely paid off. And the benefit to you is that you're going to be able to make extra money rather than just selling it for a set number. You're going to be able to sell it for that set number and then make money on top of it down the line.
And I think for a seller, and I think the reason why with sellers that actually do this, because one of the things I had in my head was like, why would a seller do this? But for tax benefits,
yes,
right?
That's the biggest one that we see for tax benefits.
So when you do an owner will carry, is this something where the owner of the property has to own the property free and clear?
Not all the time. You can do it both ways. It gets a little tricky with the mortgage in place and the due on sale clause. But I would say at least 60 to 70% of the owner will carries that I see, the properties are paid off.
Okay. Now, you mentioned a due on sales clause. What is that?
That is just when you buy a house and there's a mortgage in place, the bank is giving you the loan. Yeah. They're saying that you cannot transfer the house without letting them know. Okay. And if you do that, they're able to call that mortgage, that loan due.
So if you did do a owner will carry and there was a mortgage on it, can you still do a deal like that?
Yes, you can.
And how do you do a deal like that when, once it gets recorded, there's that due on sales clause, it comes due. Like, how do you side skirt that? Like, how does that work? You know what I'm saying?
Yeah, it's kind of a gray area, but what in my experience, as long as you're making those payments to the mortgage company on time, you shouldn't have an issue. And, I mean, it does happen, though. It is a little bit of a gray area where the title is allowed to push the deal through. They are able to transfer the sale of the house and not notify the mortgage company.
Oh, really?
Yeah.
But how does the mortgage company actually get triggered on that due on sales clause? How do they actually know?
So they know from a few ways. When you get a mortgage, what's the first thing they want? Insurance.
Yes.
So if that insurance lapses in any way, that mortgage company gets notified, especially if it's bundled together with your mortgage.
Ooh.
So that's the biggest one that I see. Two is if you don't pay it. So if you don't pay it, then they get notified. Then they look into it and they say, oh, look, the property was deeded to you, and now it's in Jason Griggs' name. They say, hey, what's going on here? Why was this deeded? And then they could look into it.
Okay. Now, could you actually do a deal without going through a title company?
In my
just
experience,
recording it with the county, you know what I mean?
Yeah, I haven't done that, but I guess you could, yeah.
But obviously you want to probably protect yourself, and that's the reason why you would go through a title company.
Definitely, right? Yeah. So when you do seller finance deals, it's kind of like a marriage.
Yeah.
If you were seller financing me a house, we're going to be married to each other for the length of the term, which we'll kind of get into with our deals. It could be a year, 30 years, 50 years, whatever. But my best advice is you have to have a good relationship with this partner.
Okay.
Because if it does get called or something does happen, you and I got to figure this out so we could fix the problem.
So there could be a liability on this, guys. So that's something that you guys definitely have to be aware of.
Definitely.
Now, have you had a note come due?
Yes, I had. It was a subject to deal.
Okay.
But yeah, it was an insurance problem. So the insurance lapsed, and they wanted a higher insurance policy, and the mortgage company called the old seller and said, "Hey, we need to update this." And the seller told the insurance company and the mortgage company, "I sold this house. I gave it away," and that's when they called it.
Now, what's the benefit for the buyer to do an owner will carry, knowing that something like this could happen? Because there are some risks here, right?
There are some risks. Let's start with having a mortgage still on the property.
Yeah.
So the risk is that it could get called. But the benefit of it is you can structure the deal as the buyer however you want. So I can buy a house with no money down. That's the number one thing that I look for.
Wait.
How could I get into a house with no money down?
So, Jay, let me ask you this. You actually bought a home with no money down. Have you done that before?
I haven't done with no money down, but very close.
What's the lowest? The lowest?
$7,000.
And how much was this house?
This house was it was listed for $250,000, and I gave the seller $300,000. So I gave him more than he wanted, but I only had to put down $7,000.
Wow. Now, was there a note on here?
It was completely paid off, so there was no note, no mortgage.
Oh my gosh. I just don't understand. Why would a seller do that when he could just sell the property, get rid of that headache, versus passing it on to you?
So in this market,
Yeah.
houses are not selling as fast as people want them to, and so I was willing to give him more money for the house. He had it listed for $250,000, and I gave him $300,000 for it.
Yeah.
So he's going to make $50,000 more, but it's going to be over a longer length of time.
Okay. So let's just say if there is a mortgage, right? The way that the deal would be structured, you would have to see exactly what the monthly payments are. So if he's making a 4.5% payment, right, you would have to at least structure it to be obviously more than 4.5%, and whatever your spread is going to be, right?
So the way I kind of educate people on it is I say, what is your mortgage payment a month? The interest rate doesn't really matter, right? So let's say it's $1,000.
Okay.
Now I have to look at my numbers and say, okay, you need to make at least $1,000, or else you're going to go underwater.
Yeah.
If I only offer you $800 a month, you're going to be like, I'm not doing this. I'm losing $200 a month. So with that, when I can see what you're paying a month, everything else doesn't matter. I can structure the deal. I could give you $1,500 a month and say, hey, look, we're going to pay off the mortgage, that note for $1,000 a month, and you're going to make an extra $500 a month.
So there's deals out there, you're saying?
There's going to be millions and millions of deals that are going to be just like this with creative finance.
So how do you even find your deals? I think that's one of the most important questions.
I've just been very vocal. I've done a lot of these deals. I've done a bunch of them, and I think Pace Morby's free Facebook group is the number one source. I love Pace Morby. Joined this program.
Yeah, Pace, you better subscribe to this channel, dog.
Yeah, Pace,
for real.
Pace is awesome, and he's like the godfather of it right now. He has, I think, like 30,000 students who do this on a daily basis. They're going to shark deals. They're going out to find these deals. But a lot of these deals are coming one of two ways. One, these people are underwater. meaning they can't afford their house anymore. Or two, it's tired landlords or people that are older and their house is paid off and they just want to make an extra income.
Okay. So it sounds like for your side, for the buyer side, you would be better off finding somebody that owns the property free and clear, so that way you don't have to deal with the headache.
Correct.
Now, you mentioned before that you had a problem where the note did come due.
Yeah, I did.
What was that story?
I had two. I'll go through both of them. So the first one I did, it was here in Las Vegas. These people bought a house. They owned it for 6 months and they couldn't afford it anymore. Okay. And so they deeded me over the property for a few $1,000s. So there was a little bit of equity, but nothing crazy. But they couldn't sell the property because with all the commissions and the fees, they would have to come out of pocket to sell it.
Yeah.
So they just deeded me over the house. I took the house and I rented it for, I think, 8 months. And then that couple got divorced.
Okay.
And so when people get divorced, you can't go and get another loan when you do something like this.
Yeah.
So we did a subject to deal. What happened was the wife got upset at the husband, blah, blah, blah. They called the mortgage company and let them know that they sold the property.
Oh, wow.
Okay, so as soon as they do that, they call the mortgage, and the mortgage calls me and says, hey, Jason, you either have to buy this house from us or you have to sell it. And so I ended up selling it.
And how long did it actually take you to sell that home, and did you actually make a profit?
I did make a profit. I made around $20,000 because I have my license. Okay. I didn't have to pay double sides of 2 agents' fees. And it appreciated in those 8 months. And I made income from the cash flow of the rent.
Now, you are a license here with Simply Vegas here in the state. Now, as far as like liability purposes, that was like one of my things where I would always get kind of paranoid.
Yeah.
Right? Because I don't want to lose my license because that's where like my bread and butter is. Like, how do you get around that?
I don't think it's getting around it. I think it's just being honest with these people. And there was nothing I could do for these people.
So it's all transparency.
It's all transparency. I give them my business card. I tell them to Google me, Google my name. But it's not anything illegal that you're doing. Like, these people had 2 agents prior. They couldn't sell the house. And the 2 previous agents that they had didn't know how to structure the deal correctly. Okay. So, in a way, I helped these people because this house was going into foreclosure. And in foreclosure, those people's credits are ruined. And now, by me taking it off their hands and giving them money to go start somewhere else, their credit is intact and it's okay.
Now, when you're analyzing these deals, are you mainly focusing on your return on your investment or how much you're just making cash flow?
Both.
Deal? Like, what's big for you? What's most important?
I think you want to get back your cash, your initial investment, your upfront down payment within 12 to 18 months. Okay. Okay. The second thing is, if that isn't possible, is there a lot of equity in the home? So you look at 2 factors. It's really preference, but I'm more of a cash flow guy, where if my payment is $1,000 a month, I need to make that $1,000 minimum back plus a little extra so I can make my down payment.
So would you take a deal on if you're only making $200?
It depends on the deal. Like, would you take on a deal? Would you break even or lose $200 a month if there's $200,000 equity in the house?
I'm going to say probably yes.
Yeah, you would, yeah. and so would I. So it's all relative. But what I'm seeing now with this downturn, because it just started, it's happening. I went on an appointment last week where the guy can't afford his house anymore, but there's no equity in the house. He just bought it.
Oh, damn.
Okay, so now he can't sell it. Nothing's really selling. It's not easy to sell a house anymore. You can't go wholesale it to a wholesaler. So he's in a tough spot. So somebody's going to have to take over this house and kind of bite the bullet a little bit, or it's going to go into foreclosure.
Now, what happens if you do the owner will carry, but you can no longer make the payments? Your side flops.
Yeah, so that's a huge factor in it. If we have an agreement and you give me the house, we do a seller finance, let's say I give you $50,000 down, and I default and I can't pay it, you get the $50,000 that I gave you, and you get the house back. Oh, so it's a great safety net for the owner.
Now, what about your credit?
There's no credit in these.
Not at all. It doesn't hurt your credit.
No, it doesn't hurt your credit unless you sue me.
Now, what happens if you do traditional financing? Because one of the issues I ran into is that, with these type of owner will carries, the lender will allow you to get up to 10 properties, and obviously you want to maximize that and you want to leverage that. But then, if you did these owner will carries, and let's say you have 20 of them, and now you went out for traditional financing, they're going to see that you own these LLCs. They realize you own all these properties. You're over leveraged.
Yeah.
That's going to stop you from getting a traditional loan, right?
It is, yeah. And it has for me. Okay. I don't really go to look for traditional loans anymore. Okay. I'm strictly doing these creative finance deals, or I'll partner with someone who can get a traditional loan.
Okay. So is there a way that you can actually show me and break it down?
Yeah, let's do it.
I want to see the numbers.
Okay.
So let's use one of the numbers with one of your scenarios in your deals. So yeah. Let's talk about the deal first. Okay. Do you have a deal in mind?
Yeah, so I just did one in Gulfport, Mississippi. I did it with Nick, who you met at the Clever, right? The Clever, what is it called?
And this is out of state.
This is out of state, total virtual. I've never been there, will never go there.
Okay.
It's just numbers. It's just numbers and running
show us the numbers here. I think this is important right here because this is going to be fun. Okay. So I'm going to let you take over. Okay. You could just start writing here. Let's see here. We're going to do this one. Okay. So how much was the deal? But let's talk about the structure of the deal. How did you get this deal first?
So my 21-year-old next-door neighbor, who you met, he went on Facebook and found someone Thai landlord that just put, I want to sell my property in Gulfport, Mississippi. It was a running Airbnb, but it wasn't doing well. Okay. So my specialty is running short-term rentals. Yeah. So it was brought to me, and I said, I think I could structure this deal to make it a win-win. Mm-hmm. All right. So here we go. Okay. So we bought this place in Gulfport, Mississippi. Okay. All right. So the guy had it listed for around $250,000.
$250,000. What was the value of the property at this time?
It was right around there. Okay. But he couldn't sell it. Okay. He had trouble selling this thing. And so what I did was I said, let's do a seller finance deal and let's offer him some more money. And let's see if he bites on it. So what we did was we offered him $300,000.
$300,000. Right. And did he have a mortgage on this thing?
No, it was completely paid off. Okay. Now you're gonna say, okay, Jason, why would he do that? Yeah. Okay, because he's gonna make $50,000 more. Mm-hmm. So now we're gonna get into the meat and potatoes of it. How did I structure the deal? Mm-hmm. Okay. The best part about this deal was that the house was totally furnished. The systems were all running in place. Yeah. So I was just going to buy the house with all the furniture and just take over the operation. Okay. He didn't want to do it anymore. He was doing it incorrectly. So I said to my partner, do you have a lot of money? He said, no, I'm 21 years old. Yeah. Okay. So I gave him $7,000 down. Okay, to the seller. So we gave him $7,000. Is that a lot of money to buy a house?
No, not at all.
Not at all.
I think a lot of you guys can save up to $7,000. Okay.
So then the next step is, that was our down payment. We're going to give him $7,000 down. And what is our interest rate going to be? Mm-hmm. Okay, so now he's the bank. This guy is now the bank. Okay?
So when we talk about interest rate, is this with principal too, or just interest only?
Yes. Okay. No, it's not just interest only with principal. Okay. So our payment, okay, so now he's the bank. Our payment,
That's okay.
All right, is to him $1,100 a month.
$1,100 a month? What was it, like 2%?
Yep. At a 4%.
Oh, wow, okay? 4%.
So I bought it, okay, for $300,000 at 4%, okay, with the $7,000 down. It works out with all the taxes, everything, about $1,100 a month. That's what I pay him every single month.
The 4%, right? Mm-hmm. You put down $7,000. What was the amortization? But also explain what the amortization is, because this is important. Because the longer the amortization is, the cheaper it is on your payment. Okay.
So great question. So this 4% was over 30 years.
Oh my gosh! What a great term. 30 years.
30 years. So what he's saying is, this seller is financing me this house for 30 years.
At 4%.
At 4%. Okay. So after it was all said and done, now I put this $7,000 in, and I paid about another $4,000 just to put some extra updates into the house.
Okay, so we're into it for about $11,000.
About $11,000. Okay. Now here's the best part. This property produces me, $3,500 to $5,000 every single month.
Oh, wow.
Okay? So now what we do is we say, okay, let's go on the low months because it's been up for about 10 months now.
Okay.
We take this number, the $3,500, and what's our all-in cost of $1,100 a month.
Okay.
And we do the math, and I'm profiting $2,400 a month cash flow.
Okay.
Okay? And then on my worst month, $3,900.
Okay.
On my better month, okay? And that's how I'm evaluating this deal. So I'm making, on top of my mortgage payment, on the low months, $2,400. On the high months, around $3,900. It'll fluctuate based on the time of year. Now, how many months is it going to take me to get my original down payment back?
About 3 months, 4 months.
I made it back within 4 months, yes.
So you made it. So let's do this. Let's take 12 times 24. What is that?
Yep, 12 times 24.
Let's get the calculator here. Because we're going to find out exactly what's going on. 12 times 24, right? 24, that equals almost 20. Oh, that's actually 28,800 a year. Within a couple of months, you've already got your initial payment of 11,000 back.
Correct.
So now the return on investment is what?
It's
infinity.
Yeah.
So basically, he got his money back. He got a property free and clear. But I want to go back to the structure of the deal because sometimes a deal could be structured with a balloon payment.
Yes.
Explain what the balloon payment is. Obviously, it sounds like this one didn't have a balloon payment, right?
Okay. Yep.
What is a balloon payment, and do you normally structure that into your deals?
Okay, so all balloon payment is a length of time.
Yeah.
So let's say our balloon is 30 years.
Yeah.
On this one. So let's say he was, Jason, I only want to do this. I only want to be married to you for 5 years. So then that would change some things for me because my number one thing that I want to do is make back my initial investment.
Yeah.
As fast as I possibly can.
Okay.
Okay? So let's just say that we weren't cash flowing as much and my 30 years was really maybe 2 years.
Yeah.
Then I would say, okay, I'm going to give you even less down, or you have to change this interest rate to a lower so I could cash flow more.
Okay.
And this is what I do with every deal. I put this on paper for the seller to say, okay, how much do you want to make a month? He gave me this number.
And you worked off this number.
He gave me the number, how much he wants a month.
Okay.
So, but remember, I'm giving him, well, Jason, you're not giving him a lot of money, but where am I giving him money?
Here.
Yes, I'm giving him $50,000 more over time.
Now, one thing that I feel let's just say you had a 5-year balloon payment. Obviously, you got this initial investment back within a couple months, but then let's just say within 5 years, you know you need to sell. Do you know if this property will be worth that $300,000? Where do you run into that risk?
Right, so that's a risk that you're taking with buying real estate.
Yeah.
It could be worth more. This $250,000, it could go jump up to $400,000 in 5 years. But I had a good feeling about the area. I did my research with the property manager, with a local real estate agent there, and I was just confident that with this low down payment, I was going to make my money back and continue to run the business. So now I'm making really good cash flow. Well, I have a nice reserve.
Yeah.
So I have about a year's reserve that if the Airbnb shuts down or just not doing well, I could turn into a long-term rental and I would still be okay. Because the long-term rental of this would be about, I would say, $1,800 a month.
And by then, you've already made your money back.
Yep, and we're just free rolling it.
Okay.
And so this is the best way to structure it. The number one question you should ask the seller is, how much do you want to make a month?
Yes.
Right there.
So you kind of reverse it from there.
Reverse engineer from there.
Change the terms, change the price.
Exactly.
So what really benefited you was that he owned it free and clear. The 4%, this is what he wanted.
Yep.
And the sweet spot was, look, when I sell it, this is what you get.
Yep. So this guy, I don't know if he fully thought through it or just didn't realize like how long 30 years is, because he's an older gentleman.
Yeah.
So we're probably going to get him out at around year 10, if I had to guess, because he's getting a little older. And so what would happen, I would refinance the property or I would just pay it off.
Okay. Now, if somebody's actually interested in doing this, right? Because a lot of people are watching this right now, they're like, dude, I just don't get it,
right?
Which is totally understandable.
Okay.
You also have a course.
Yep.
Okay. On Airbnb.
Yes.
Short-term rental.
Short-term rentals.
And right now, you are the #1 guy in Las Vegas for short-term rentals. You're killing, you're crushing it.
Appreciate it.
Now, you also have a program that's out there.
Yep.
Okay. And let's do a quick pitch on this program.
Okay.
How much is that program?
So it's $1,500.
What am I going to learn?
You're going to learn everything about short-term rentals.
Break it down.
All right.
I want to know.
So the biggest issue that I see with short-term rentals is people don't know where to get started. And so this is like a step one. How to, and I just don't do it here in Las Vegas. I do it all across the country, as you can see. So they don't know where to go find these properties. Okay. First step is you need to find a real estate agent. You need to find the property to buy. And then you have to learn the business of how to furnish it, manage it, and operate it. And so I help you. I sit down with you. You watch the course. And then I sit down with you after, and we get on a coaching call of how to, one, structure these deals, and two, how to find them. Because not every market is good for short-term rentals.
Got it. Now, guys, what I'm going to do is I'm going to have a link in the description below. So that way, if you guys want to jump on this course, I would highly recommend that you guys do. Before we let these people go, is there anything else that you want to say about this deal or anything that you want to share?
No, I think you need to learn not only just regular investors, every single agent should know how to do these. Because
that's a good point, actually.
So can we clear this for a second?
Yeah, let's do this. We're going to move on to the second page.
Here we go. So if you have a house, okay, what are you seeing right now in the real estate market? How long are houses sitting on the market?
Right now, it's average about 45 days.
45
Median
days.
price point for a home for a resale is about $450, 1,800 square feet, 3 bedrooms, 2.5 bathrooms. There you go.
Guy knows his stuff, right? Okay. So you work with a lot of sellers.
Yeah.
Compared to last year, are they getting impatient? Are they unrealistic?
With the sellers?
Yes.
The sellers now are dramatically dropping the price because of all the propaganda.
Yep.
They feel like they got to get off the ship as fast as possible.
Yep.
And what I'm seeing is price reduction after price reduction.
Okay, so let's say you have a client, he bought his house for $1 million. It was worth $1 million last year, okay? And you're putting this thing on the market, and it can't sell.
Yeah.
It can't sell. So now you're constantly dropping it. Now you're down to $750,000.
Which is, I've seen, especially at this price point.
We've seen this recently,
Yes.
okay? So this is a good example. Now, what if you, now, I want to buy this house that you're selling, and I say, hey, I'm going to give you the $1 million. I'm going to give you the $1 million. But I want you to finance it to me for 7 years.
Yeah.
So now you're giving, hey, Mr. Seller, do you want that $1 million? You can get it, but you're going to have to wait a little extra time. Are you in a rush for that money? I'm going to give you a down payment, or we're going to sell, this could go down to $600,000.
Okay.
What do you want to do?
So
and
now you're giving them the option.
Now you're giving them an extra option. Some people might play it safe. Yeah, give me the $1 million.
Now you mentioned the 7 years. So guys, he's talking about a balloon payment right there, right? So let's just say, example, if he said, hey, I'll do it for $1 million, 7. Let's break this down. $1 million, right? Balloon payment of 7.
Yep.
7 years. How do you structure the deal now as far as what the interest rate is? Is that going to be based upon now? The question is,
yeah.
What do you want?
That's
a month, right?
That's the best part. What do you want month? What am I comfortable paying?
Yes.
So the reason why I use this example is because I'm looking at a house that was priced at $1 million.
Yeah.
Okay? It's not selling. So I approach the agent and the sellers. I'll give you the full $1 million, but I want my payment to be around $4,000 a month. Now, if I were to go get a loan right now with a traditional mortgage, my payment would be around $6,000 a month with a 7% interest rate.
Yeah.
So what if I gave you the $1 million for 5, and we did a 7-year or 5-year term? You're going to get your $1 million because we don't know how low this is going to go. But it could go up. But right now we're trending down. Okay,
and I think the negotiating part here is if it's not listed at $750, but you're willing to give them $1 million, the negotiating part is we put 0 down.
Correct. Or I was willing to give 10% down. Okay. When I do these deals, I always do it like this. I start with 10% down, 5% interest.
And that's interest, principal and interest?
Yep, always. Okay. Always. I never do interest only.
Okay.
Okay? Okay, for 5 years. This is how I always
So this is kind of where you start.
I always I call it my start structure.
Okay.
10% down, 5% interest, 5 years. I always start it with that.
Okay.
Okay? Then I work backwards. If they say, Jason, I want more, I want a higher percent down. Okay? I want 20% down. Okay. Okay, then I want a lower interest rate. I only want to pay 3% interest, and I want a longer length of time.
Okay.
What does that do? All it does is it's just keeping my payment where I'm comfortable. That's all real estate is. Where is your payment comfortable? Is it comfortable in the rental market? Because if it's too high and it's not comfortable, then you can't rent it and you can't cash flow. So you need to make sure, this is a personal property I'm looking to buy for myself. But I'm comfortable at $4,000 a month. I know that. Okay. I can't spend $1 more than $4,000 a month for a personal house. Now, what if I don't pay? Let's say in this $1 million house, I gave him $100,000. We'll do mine. So $100,000 I put down.
Okay.
Right? Something happens to me. I can't pay this mortgage payment anymore. He gets that $100,000.
Oh wow.
He gets to keep that $100,000, and he gets his house back. So let's just say it was at $750. He gets another $100.
That's $850.
That's $850.
And he gets the house back.
And he gets his house back. So it's very protective for sellers. Very, very protective for sellers.
So would you do a deal like this by putting down $100,000?
I would, absolutely, if it made sense. But you have to trust this seller, because if there's a mortgage on this thing, this one I don't think is going to work out, because his mortgage payment is around $5,500.
So that number's not going to work for you.
No, because there's that gap, right? Okay. There's that upside down gap, so it's not going to work.
You mentioned $100,000 down, but there's a lot of people out there that don't have $100,000 down. So then now we need to restructure this.
Yep.
Let's run a scenario. Let's do another page. Okay. Let's run a scenario. Let's just say I only had $10,000 down. Show me how to structure a home for $500,000. Let's just say. So if you did one for $500,000, all right, what's your mortgage payment? That's step one. Okay. What are you comfortable paying every single month? Okay, so we know around $500,000 right now is about $2,300 a month based on today's rate. Let's just say I am actually the seller. Yep. My payment right now is about $2,300 a month. Okay. $2,300. That's what I got to pay for my mortgage. Yep. So I come to you, I say, Jay, yo, I will sell this thing to you, but I need at least $2,300 a month. Right. Okay. Run the scenario. You're buying this deal from me. All right. So we're here at $2,300, but we only have $10,000. Is that what you said? Yep. We only have $10,000. All right. So we're gonna put $10,000 down. Okay. I would offer just that amount. That's it. That's it. I'm giving you $2,300. You're breaking even. But I'm going to have to give you some interest, or I'm going to have to juice this price up a little bit. Maybe we juice this up to $525. I like writing this thing, by the way. It's cool. It's cool, right? It's really cool. Yeah. It's like soothing. All right, I'm going to give you an extra $25,000. I'm putting 10% down. Maybe we do no interest. We say no interest on this. But I'm guaranteed to get my $25,000. You're going to get you $25,000. All right. Now it's the length that's going to come into play. Okay. How long are we going to do this? So I'm only going to give you the $2,300. I'm only going to give you $10,000 down, or no money down, and I'm just going to give you $2,300 a month. But the question is, can I afford this $2,300, or can I rent it for more than $2,300? So I think that's another compensating factor that you guys need to be aware of, is what are the rental comps and what is your strategy behind this property, because you do short-term rental. Yes. This could be a short-term rental. Let's just say if it was, it could be at $5,000 a month. Exactly. Or if it's just a regular long-term rental, at 28, you're cash flowing $500 a month. So the cool part about these, and I highly recommend you go on YouTube and check out All Pieces videos, because he can structure any deal any type of way, and you can too. You can say to the seller, hey, Mr. Seller, maybe I'm only going to give you the $500. Or maybe I'm going to give you $25,000 more. What do they want? Yeah. So you have to take what they want with what you need and mesh it together and make a marriage out of it. So you can't always make it happen just based upon the number. No, because like the last appointment I went on, this payment was too high. Okay. So I couldn't rent the house out for that $2,300. So it seems like the first thing to do is when you get a lead, find out exactly what their minimum monthly mortgage payment is and run the rental comps. So you're going to run mortgage. Okay. Then we're going to run long-term rental comp, and then short-term rental comp. How do these compare? Because short-term rentals, they don't always work. Yeah. So you might be able to get this $6,000 a month
okay, on a short-term rental, but only get around 3 on a long-term rental. Okay, so now you're kind of cutting it close here.
Yeah.
All right. If something happens or the rate, the market of the rental goes down a little bit, but here you're kind of sitting pretty. Okay, you got a nice gap there, a nice cash flow gap that you can make work. But what I'm seeing a lot of people when they do kind of tying this into short-term rentals is people don't realize how expensive furniture is.
Yeah.
So yeah, I'm getting into a house for $10,000.
So this number is going to drop, basically.
Yeah, because you're going to have expenses.
So if we went with $3,000 a comp, you're making $700. That is, let's just say, what is that? $70, $80, $8,400 a year, right?
Yeah.
But you got this down. This is where you need to focus on. 10% of this is $52,500.
It's a pretty good deal.
You're making what, roughly about 82. So you take this 8,200 a year. You need to divide it by the 10% down, and it's going to determine how long you need to hold on to this property just to get your money back at that point.
Which we call the cash on cash return.
Yes. Okay. And I think that's very important, and I think that's something that you need to evaluate, because if your term is only 5 years, you need to make sure to get your initial investment back in 5 years. But sometimes it may not even be worth it just to get it back, but all you did was hold on to the property. So you got to make sure you're also cash flowing too as well, and I think that's a big deal.
Huge.
So
we're going to see a lot of this with first-time home buyers.
Yeah.
Okay, because people that work in we'll call it the casino industry, they're kind of maxed out at their salary.
Yeah.
They're not going to be able to afford a $3,000 to $4,000 mortgage payment off their salary, right? So they're going to start looking for things like this, where can I put less money down?
Yeah.
And the interest rates are really high right now.
Yeah.
So you put high interest rates into this, and your mortgage payment is exploding, and that's what's happening right now. So it's all about affordability. Can these people afford it? Can you afford it? And there are a lot of opportunities where it's a win-win.
Now, I think the next video that we need to do, because this is the owner will carry, I think we need to talk about subject to financing. We ran a little bit longer in this video, but this is more for educational, and I think this is great information. Follow my man on Instagram. I'll have all the links in the description below.
J. Griggs Real Estate, and then if you have a deal, present it to us, because we're buying.
Yeah, that's a good point.
We're buying.
That's right. Yeah, I'm actually getting into the game with my man here. I'm trying to get in that money. I want that money. Call me now. Nah, just kidding, guys. Here's the thing. If you guys have a deal out there, or if you're even like a wholesaler, you guys got deals, bring us the deals. We definitely want to analyze it, and we want to take it down.
We'll analyze it and we'll partner.
Exactly.
I partner with a lot of my students. It's great.
All right, man. I appreciate you, my brother.
You're the best.